let me ask you something, and I want you to be honest with yourself. You've heard about options trading, right? Maybe you saw someone on Twitter bragging about turning $5,000 into $50,000 in a single week. Maybe your colleague mentioned it at lunch. Maybe you've been watching trading videos for months, but every time someone explains options, they throw around terms like Greeks, implied volatility, theta decay, brain just shuts off. I get it. I've been there. When I first heard about options trading, I thought it was only for Wall Street hedge fund guys sitting behind 6 monitors drinking cold brew at 4 a.m. Not for regular people like me. Not for regular people like you. Here's the truth nobody tells you, and this is exactly why I made this video. Options are actually one of the most powerful, most flexible, and, when used correctly, one of the safest tools available to retail traders in 2026. Yes, I said safest. Stay with me. In this video, I'm going to break down options trading in the simplest way possible. No unnecessary jargon. No complicated math. Just plain English, with real examples, so that by the time this video ends, you will understand options better than 90% of people who have been in the stock market for years. We're going to cover what options actually are, explained with a story even a 10-year-old could understand, with the 2 types of options, calls and puts, and when to use each one. The 5 key terms you must know before placing a single options trade are real-world examples using stocks you actually know. 3 beginner-friendly strategies that work in 2026 market. The biggest mistakes new traders make, and how to avoid them, is the video I wish I had when I started. So grab a pen, get comfortable, and let's get into it. The real estate analogy, alright? Let me paint you a picture. Imagine you found the perfect house. It's listed at $300,000. You don't have all the money right now, but you believe that in the next 3 months, neighborhood is going to boom. Property values are going up. You know it in your gut. So you go to the seller and you say, hey, I'll give you $5 right now for the RIGH, not the obligation, but the RIGHT to buy this house at $300,000 any time in the next 3 months. The seller agrees. You've now got a kind rice tea. 3 months later, 2 things can happen. Scenario A, the neighborhood booms. The house is now worth $400,000. You exercise your right, buy it at $300,000, and you just made a $100,000 profit minus the $5,000 you paid. Net gain to $95,000. Scenario B, nothing happens. The house is still worth $300,000 or less. You let the contract expire, you lose your $5,000. That's it. That's your maximum loss. And OPTR. You paid a small fee for the RIGHT to buy something at a specific price within a specific time frame. You are never forced to buy. Your maximum loss is only what you paid for that right. In the stock market, this works the exact same way, except instead of houses, you're dealing with shares of companies like Apple, Tesla, Amazon, or the Nifty 50 index. The official definition, an option is a contract that gives the buyer the RIGHT, not the obligation to buy or sell an underlying asset at a predetermined price, called the striker price E, before or on a specific date, called the XPII date. Now, there are 2 sides to every options contract, the BUR of the option, who pays a premium and gets the right. The seller of the option, also called the WRITR, who receives the premium and takes on the obligation. For now, we're going to focus entirely on being the BUER. That's where most beginners should start. The risk is limited, potential reward is enormous. Why options exist? Options were originally invented not for speculation, but for time. Farmers use them to lock in crop prices. Institutions use them to hedge their portfolios. That's why, when used correctly, options can actually reduce your risk. But in 2026, retail traders, that's you and me, options for 3 main purposes. A leverage control more shares with less money, a hedging protect an existing position from losses, a income, collect premium by selling options, call options, betting the price goes up, a call option gives you the right to buy shares at the strike price. You buy a call when you think the stock is going to go up. Think of it like this, KLING, the stock higher. You're calling it to rise. Real example. Let's say Apple stock is trading at 200. You believe Apple is about to release a massive product announcement, and the stock is going to jump to 230. Of buying 100 shares of Apple for $20,000, you buy a call option with a 200 strike price expiring in 30 days. That contract might cost you $500 in premium. Apple jumps to 230, your call option is now worth roughly $3. You turn $500 into $3, a 500% return, without ever owning the stock. Apple goes to W or stays flat, you lose only your $500 premium, maximum loss. Done, put options, betting the price goes to W. A put option gives you the right to sell shares at the strike price. You buy a put when you think the stock is going to go WN. Think of it like this, tying the stock down. You're putting it lower. Real example. Let's say Tesla is trading at 250. You've been following the news, there's a recall, earnings are expected to disappoint, and the chart is showing a major breakdown pattern. You think Tesla is heading to 207. You buy a put option with a 250 strike price expiring in 45 days. That contract cost you 600. Tesla drops to 210. Your put option is now worth $4,000. You just made 400 profit while the stock went dododluan. You made money in a falling market. This is the super ARPA of options. You can profit whether the market goes UP or dodluan. Stock investors can only profit when prices rise. Options traders can win in both directions. Tichi 5 kai tam swayu maskanu. Alright, now that you understand the concept of calls and puts, let's talk about the vocabulary. I'm going to give you exactly FIV terms. Are the only ones you need to start trading options. I'm keeping this simple on purpose. Term FA1, Starkey price E. Strike price is the price at which you have the IGHT to buy or sell the underlying stock. Example, you buy an Apple call with a strike price of 200. That means you have the right to buy Apple at 200, regardless of where the market price is. If Apple is trading at 230, your 200 strike call is very valuable. Apple is at the 180, your call is likely worthless. Term FA2, XPRI owned, every options contract has an expiry. After this date, the contract is worth 0 if not exercised. This is one of the biggest differences between stocks and options. Stocks can sit in your account forever, have a ticking clock. You can buy options that expire in 7 days, 30 days, 90 days, or even a year or more. As a beginner, I recommend 30 to 60 day expiry. Not too short, not too long. Term 23, pyramimium. The premium is the price you pay to buy the options contract. It's like the ticket price to enter the game. Call is priced at 500, and one options contract represents 100 shares. You'd pay 5 odix 100 at 500 total premium. This 500 is your maximum loss. Everything goes wrong, you lose your 500. Nothing more. The premium is determined by several factors, the most important being how far the strike price is from the current stock price, how much time is left before expiry, and how volatile the stock is. Term 84, Oyut Auft Muni. These terms describe where the current stock price is relative to your strike price. For a call option, YNTHE Muni Y, stock price is above the strike price. Your call has intrinsic value. OUTOFT Manuif stock price is below the strike price. Your call has no intrinsic value yet. 8T MMI, stock price equals strike price. For a put option, it's reversed. The ITM put stock price is below the strike. Your put has real value. OTM put price is above the strike. It hasn't moved in your favor yet. Why does this matter? ITM options are more expensive but more likely to profit. They're cheap but riskier. As a beginner, I recommend trading slightly OTM or ATM options for a good risk-reward balance. Term FA5 T8 is the OE concept that destroys beginners without them even knowing it. Theta is the rate at which your option losses vary every single day simply because time is passing. Think about it this way. If you buy an option that expires in 30 days, every single day that passes, the clock is ticking and your option is losing a small portion of its value. Even if the stock price doesn't move at all, is called time decay, and it works against the option buyer. The closer you get to expiration, the faster the decay accelerates, is why holding a short-term option and hoping the stock moves is a recipe for disaster. You need the stock to move, and move QIFKLY. 4 theta eats away your premium, KYRIing theta is your enemy as a buyer. Never buy options right before expiry unless you're an experienced trader with a specific catalyst in mind. 3 bigger and our strategy hat marker A 2026, okay? You now understand what options are, you know calls from puts, and you know the 5 key terms. Now let's talk strategy. Knowledge without application is just entertainment. I'm going to give you 3 strategies. These are not the fanciest strategies. They're not the ones hedge funds use. These are the 3 strategies that a new trader with a small account can use RIGHT Nundu to start making intelligent decisions. Strategy 1, the earnings play. Every publicly traded company reports earnings 4 times a year. And every single time, the stock has a big move, either UP or WN. Here's the play: you identify a company with upcoming earnings. You study the chart, the analyst expectations, and the recent news. If you believe the stock will beat expectations and move UP significantly, you buy a call option that expires 1-2 weeks after the earnings date. Key is buying before the announcement, when the premium is still reasonable, and riding the wave after. Example, Amazon reports earnings next week. The stock is at 3,200. Expect strong cloud revenue. You buy a 250 call expiring 10 days from now for 800 premium. Amazon beats earnings. Stock gaps up to 400. Now worth 5,000. Now you made 200 profit on an 800 investment. That's a 525% return. Riskwar earnings plays a high reward but also high risk. In misses earnings, the stock can drop sharply. Never put more than 2-3% of your total capital into a single earnings play. Strategy Phase 2, the trend ride, is the most straightforward strategy for beginners, and honestly, it's underrated. The concept is simple: find a stock that is in a clear, established UPT ride. Ride the trend. Sell before expiry. How to identify an uptrend. The stock should be for making higher highs and higher lows on the daily chart, for trading above its 50-day and 200-day moving averages, or with increasing volume on up days once you've confirmed the trend. OTM call with 34.5 days to expiry. Set a profit target of 50-100% return on the option. Set a stop loss at 30-40% of the premium paid. Strategy works in 2026 because, despite short-term volatility, certain sectors, AI, semiconductors, green energy, and healthcare, have been in sustained uptrends. You can ride these sector trends using index options or leading individual stocks. PRO tip: use the weekly chart to confirm the major trend and the daily chart to time your entry. When in doubt, go with the trend. Strategy Phase 3, the protective put. This strategy is for those of you who already own stocks and want to protect your portfolio during uncertain times. Imagine you own 100 shares of Tesla at $250 each. That's a 25,000 invested. The market is nervous. Rates might go up. There's geopolitical tension. You don't want to sell your shares, but you're worried about a drop. You buy a put option on Tesla with a strike price of $240, expiring 60 days from now. This costs you, say, $600 in premium. Now here's what happens. If Tesla drops to 200, your put option is worth 4,000 plus. That profit offsets much of your stock losses. You've hedged your position. If Tesla goes UP to 300, your put expires worthless. You lose 600, but your stock position made 5,100. Net positive. Paid 600 for peace of mind. Think of the protective put like insurance on your car. You pay a premium every month. You hope you never have to use it. Something bad happens, you're protected. This is options used the way they were originally designed for pirati time. BGGista my sticky seni wdars Mikey. Alright, we're in the home stretch. This section might be the most valuable one in the entire video, because these are the mistakes I see new options traders make over and over again, and they're completely avoidable. Mistake Phase 1, buying too short-dated options. New traders low cheap options. A 50D option expiring in 5 days feels exciting. Huge leverage, tiny cost. But here's the brutal reality: short-dated options need the stock to make a big move in the RGHT direction in a VRSR time. That's 3 things that all have to go right simultaneously. The odds are stacked against you. Theta eats these options alive. Stock moves in your direction slightly. Theta decay will often wipe out your gains. Solutions start with 34-5-day options. Give your trade time to work. Mistake point 2, not having an exit plan. Most beginners buy an option and then just watch it. They don't set a profit target. They don't set a stop loss. Stare at the screen and make emotional decisions. Professional traders Weiss have an exit plan before they enter a trade. They know exactly at what price they'll take profits and at what price they'll cut their losses. A simple framework: set a profit target at 50-100% gain. Set a stop loss at 30-40% loss. Stick to it no matter what. Mistake Phase 3, over-leveraging. Risking too much. Options give you incredible leverage. 500 can control 20,000 worth of stock. This feels amazing when you win. It's devastating when you lose. New traders often put their entire trading account into one options trade, expires worthless, and they're wiped out. Game over. The rule is simple: in any VR, risk more than 2-5% of your total trading capital on a single options trade. If you have a $10 account, a single options trade should never exceed 200-500. This way, even if you lose 10 trades in a row, won't happen if you follow good strategies. You still have 50-90% of your capital intact to keep trading. Mistake Phase 4, ignoring implied volatility, is the advanced one, but I'd be doing you a disservice if I didn't mention it. Implied volatility measures how expensive options are relative to the expected movement of the stock. When IV is HIGH, options are expensive. When IV is low, options are cheap. Buying options when IV is extremely high, like right before major news, means you're overpaying. Even if the stock moves in your direction, the drop in IV after the event can actually cause your option to lose value. As a beginner, just remember, try to buy options when IV is rela to IVL YLOW and sell when IV spikes. Buy cheap, sell expensive. Mistake point 5, trading without a plan or education. This sounds obvious, but I see it every day in trading communities. People watch a YouTube video, even a great one like this one, and then immediately start trading real money the next day. Paper trading first. Paper trading means simulated trading with fake money. Every major broker offers it. You get to practice entries, exits, and strategies without risking a single real dollar. Spend at least 30-60 days paper trading options before you put real money in. Track your trades in a journal. Review what worked and what didn't. Only then, with a track record of profitable paper trades, should you consider going live. OPTIONS TRADNG in 2026 Moist DFRant. I want to take a moment to talk about the current market environment, because 2026 is a unique time to be learning options trading. Understanding the landscape will give you a serious edge. The rise of retail traders. Since 2020, retail trading has exploded. Platforms like Robinhood, Webull, Zerodha, and Upstocks have given everyone access to options markets that were once exclusive to professionals. There are now hundreds of millions of retail options traders globally. Is both a blessing and a curse. More liquidity means tighter spreads and better execution. But it also means more competition and more market manipulation around popular strike prices. My advice: avoid overly crowded trades. For setups that aren't on everyone's radar. AI and algorithmic trading. In 2026, AI-driven trading algorithms dominate short-term options pricing. Markets move faster, news gets priced in faster, and technical setups can break down more quickly than they did 5 years ago. This means give your trades more time. If you're used to quick 3-day options plays, consider moving to 2-4-week timeframes to give the setup room to develop. Volatility is your friend, and 2026 have seen heightened volatility driven by geopolitical tensions, interest rate uncertainty, and technology disruption. For options BUAS, volatility is generally good news, because bigger price moves mean bigger option payoffs. But you need to be on the IGHT side of the move. This is why technical analysis, sector rotation understanding, and macro awareness are more important than ever in 2026. Alright, we've covered a lot of ground today. Let me give you a clear, step-by-step action plan so you don't leave this video feeling overwhelmed. Your 5-step action plan. 1. Open a brokerage account that offers options trading. In the US, TD Ameritrade, ETRAD, or Robinhood. In India, Zerodha or Angel One. Enable paper trading. 2. The basics first. Spend 2 weeks paper trading simple call and put buys only. Don't touch spreads or advanced strategies yet. 3. Pick 5 stocks you understand. Apple, Amazon, Microsoft, Reliance, whatever you follow. Know their earnings dates, their trends, their volatility. 4. Keep a trading journal. Write down every trade, why you entered, what you expected, what happened, and what you learned. This will make you a better trader faster than any course. 5. Never stop learning. Subscribe to this channel. New strategies, market analysis, and educational content every week. The more you learn, the more you earn. Let me leave you with this. Options trading is not gambling. It's not a scam. It's not just for the rich. It is a skill. And like every skill, driving a car, cooking a meal, playing an instrument, takes time, practice, and patience to master. But the beautiful thing about options is this: you don't need to be right 100% of the time to be profitable. You just need a solid strategy, disciplined risk management, and the patience to let your edge play out over time. People who blow up their accounts are not the ones who lack intelligence. They're the ones who lack discipline. Don't be that person. You now know more about options than most people who call themselves traders. Use that knowledge responsibly. Start small. Stay patient. And always protect your capital. If this video helped you, please hit the like button. It genuinely helps this channel reach more people who need this information. Drop a comment below and tell me what's the 81 thing you learned today. I read every single comment. And if you want to go deeper, I've got videos on options Greeks, strategies like iron condors and bull call spreads, and live trade breakdowns, all in the playlists below. Go check them out. Until next time, trade smart, protect your downside, and I'll see you in the next video.